Hey there, everyone. My name is Ryan Schul. Welcome to my data science and analytics channel. So in the topic today, I want to look at personalized loan approvals. Okay, I worked for probably about 10, maybe 11 banks over the course of time. So I worked in a lot of different teams where we had to do this kind of analysis and review potential loans that we would provide for customers, right? And it could be a bunch of different things. Maybe from a credit card, which isn't really a loan, but you're still like lending money, right, on a monthly basis. So potentially a credit card, but more like home loans, school loans, and car loans, and things such as this. Loans for small business owners, right? Something that could be probably what's the word? Not subsidized, underwritten or collateralized, right? You'd have some kind of collateral behind the loan, but not necessarily, right? So you can make loans to students. A student can go get a loan. There's no collateral behind that loan. If for whatever reason the student doesn't pay off the loan, they can't give you their education, right? There's just no collateral there that you can collect. But with a car and a house, you certainly have the underlying asset, right, that you could go and take and fetch if the borrower decides that they're not going to make good on the payments for that loan or whatever, right? So anyways, that's the topic, personalized loan approvals. We're going to focus on a couple of different things. PD is probability of default, right? The person might default on the loan. It should be pretty low in most cases, but it's not necessarily zero. Loss given default. So if the loan is defaulted on, what's the loss to the business, right? It's not going to be 100%. Again, usually people tend to make payments at the beginning for months and months, maybe for years and years, maybe, who knows, a quarter of the way through, halfway through, maybe the person defaults on the loan, but you still have collected some payments, and you probably still have some tangible asset that you can go and claim because that's the collateral for the loan, right? Except for credit cards and student loans, and I think there's a couple of exceptions like that, but most of the time there's some kind of asset behind the loan. So ACC is a probability that the loan will be accepted or be approved, whatever you want to call it. And there's a optimizer that searches the entire grid. You'll see in a couple minutes. We create an APR based on the term, the affordability of the loan, the debt to income, payments to income, things like this. We look at a bunch of different features for the borrower. And like things like, does the borrower have other loans? If you have 10 other loans, do you want to be the bank that's giving this person loan number 11? Probably not. They probably already have a lot of debt. But if they have had other loans, they repaid all those loans, that's something you want to be aware of too, right? So if you had a loan and you have good credit history, that's totally fine. We can issue credit to this person, right? If you have applied for 10 loans and you defaulted on 10, we're probably not going to issue a loan to this person, right? But you have to look at all these different features and all of these different features, or sometimes people call them columns, in the data set, okay? So let me go ahead and run the code. I will give you all of this code so you don't have to like take little notes now or whatever, or try to memorize all this stuff. I'm going to give this to you, okay? So you can have it forever and you can play around. And I would encourage you to go ahead and change some of the things in the code and see what kind of impact that has on the final calculations, right? See what's going to change. That's how you learn this stuff. So we have a few different features. We're looking at FICO scores, loan to value, debt to income, income of the individual that's applying for this loan, the loan amount. That's going to be important too, as is secured or unsecured. That's what I just mentioned before. And the age of the borrower, okay? So that could have an impact. Not necessarily, you can't say older people will or will not default and younger people will or will not. It's not really age-based, but it's still an important feature to include in the data set and to analyze. The term of the loan, the APR, annual percentage rate on the loan, unemployment, funding rate, things like this. These are all features that are going to help us to determine, is this a person that we want to do business with or not, right? So FICO scores, loan to value, debt to income, income for the person, loan amount. So you can see everything. Everything is accounted for in this data frame, okay? So just look in here. Yeah, that looks fine. Okay, default rate. Most of these you should see 0. If this is a 1, so that is a little bit of a red flag right there. Do we want to do business with somebody that previously defaulted on the loan? Maybe, but maybe not. Okay, so we have 60,000 different people here, so it's a pretty rich data set. It's more than enough to do an analysis. So we basically I created synthetic data, right? I want to simulate historical lending data, and I don't have actual lending data. I don't work at a bank right now, and even if I did, I can't take their data and broadcast that into YouTube, right? That's doesn't make any sense whatsoever. That's all private and confidential information for the bank. I'm just saying if you work for a financial institution or a bank or credit card company or something, right? You could take this code, plug it into your system, and run it right out of the box, right? But obviously, I don't have your credit history, right? Like that's personal confidential. So that's what we're looking at here, probability of default, loss given default, and the acceptance. Is this loan going to be accepted and approved or not? So we can move on here. Affordability guardrails. So this basically rejects candidates if their debt to income is greater than 0.45 or payment to income is greater than 0.35. So there's a few features, just common sense. We don't want to lend to these people, right? That's why we have to collect this information. What is your debt to income? If it's greater than 0.45, you're walking, right? I'm not going to do business with you. I just can't afford it, right? That's high risk for the bank. There's a couple things you could say immediately, like this doesn't make sense to engage in some kind of loan business with this person. It's risky business. That's it, okay? And payment to income, if it's greater than 0.35, you're just not making enough money to pay the interest and the principal on this loan if your income is below a certain threshold. It just doesn't make sense. So there's a couple of things we can focus on immediately and just say we're not doing transactions with these type of people, but the analysis gets way more complex than that, right? So these are just low-hanging fruits that we can just kick out right here. And it's not discriminatory or any discretionary thing like that. It's just like, this is high risk. We're not engaging in this business. So now I have a couple of things over here: probability of default, loss given default, and acceptance rates. And I have my X variables and Y variables. I'm not going to get into the whole thing over here. I'm splitting the data, but I have several other videos on my YouTube channel where you can figure out how all this stuff works in great detail. We have the training, testing, and we're splitting out the data, right? Basically, in a couple of seconds here, you have to split the data, right? So if you have 100% of the data, normally you would take about 70%, it could be 75%, use that as the training set, and you'll have a holdout set. That's going to be the remainder. That could be 25% or maybe 30%. And you will do the analysis on that 75% of the data, right? The holdout set is 25%. You do your calculations and then compare that to what the 25% actually was. And that's how you can see how accurate the model is performing, right? You can look at different statistics like R squared, root mean square error, mean average error. So if the R squared is high and the errors are low, the model is learning, it's making predictions very accurately, and you're in a good spot. If not, then you have to change the hyperparameters, choose a different model or whatever, right? So that's it in a nutshell. So we have the probability of default, loss given default, and the acceptance rate down here. And I think I just ran this. So I'm not going to do this again. And again, the code does get a little bit complicated. Don't worry about it. It's going to run. I guarantee it's going to run. I tested this thing pretty thoroughly. If you have questions, Google it. That's how you learn. Google is actually a skill. That's a very highly desirable, high in-demand skill. Use ChatGPT if you have questions about that. If you have very specific questions just to this code, why did I pick this? Why did I do it this way? You can post that in the comment section. But these general types of questions, I would encourage you to Google it. You'll get an answer much faster doing it that way. So we have the model set up, train tested. Everything's good to go. Here we are displaying the top APR. This is the annual percentage rate based on the term and based on the profit. So remember, the assumption here is we work for some type of financial enterprise, a bank, maybe a credit card company, maybe a savings and loan or something like that, right? We're trying to figure out the debt to income, the loan to value, the ability of our customers to repay this loan, right? And that's our book of business. That's what we want to focus on and make sure that the risk is pretty minimal. And there's going to be some defaults on the loan. That's guaranteed, right? But you want to kind of nip that in the bud and keep that pretty bare bones, and then extend money to the rest of your clients as long as it's passing this obvious threshold over here, this one that we just looked at, right? But you will have some defaults. So the risk here is you don't have to lend money to anybody, right? You can lend zero money, zero risk. That's fantastic. You don't have anything to worry about. Nobody's going to default because you're not lending any money. But you're not making any money too because you're hoarding your money. You're not issuing any loans. And yeah, there's zero risk to your business, but you're not making any money. Now you can give loans to every person that comes along. The risk there is some people are not going to be able to repay these loans, and now you are putting yourself in a tough spot because you're issuing too many loans, and there's going to be a bunch of defaults. So the thing with this model is, and all of these types of problems is, you want to find a sweet spot between lending to the right people as much as you possibly can, right? And some people will default, but minimizing those defaults, right? So you don't want to lend nothing, you don't want to lend everything. You want to find something in between that's going to be profitable for the business, all right? So let me go ahead and run this. So this is the plot here. I always say a picture is worth 1,000 words. We're going to generate a couple charts and graphs in just a minute here and see visually how everything works out, right? So I like these plotly charts. They're very interactive. They're very dynamic. Again, we're looking at the bottom axis is going to be the APR percent. Okay, this is the interest rate that we could offer to different individuals. The left vertical axis is going to show me how much money we can expect to make from that loan, right? So we want to compare the APR to the potential money that we're going to make on the loan. That's the profit for the bank. And the right vertical axis is going to be the chance that the borrower says yes and actually accepts it, right? So there's a couple things happening here. We're looking at the APR, the annual percentage rate. How much are we going to potentially make? The left axis is going to show us the expected profit. Just because we offer the loan to the person doesn't mean that the person will actually accept. Maybe they change their mind at the last minute, right? So you can make a lot of money potentially, and the profits can look great, but maybe something happens with that potential customer. All of a sudden they can't take the money, something changed on their end, they're not eligible for that anymore. So just because the person says, I want the money, and you say, well, this is going to be a huge profit, let's greenlight this thing, doesn't mean that it's guaranteed to become an actual loan that has been issued, okay? So we're going to see a couple different colors here. The chart, I'll be honest, like I didn't think it takes this long to render the chart, but I think it is working. I see the hourglass in the upper left-hand corner. I'll give it the benefit of the doubt. So keep going here. So each color is different depending on the length or the term of the loan. Solid line shows the APR changes, and the dotted lines will show the acceptance for that APR as it changes over time. The best offer is usually the solid line that has good high profit, right? The higher the better. And in the graph, we'll see the longest term, which is 84 months, has the highest profit. So think about this, right? If you give a person a loan for 6 months or 12 months, you're going to make money for those 6 or 12 months or whatever. But that's not going to be a huge profit, probably, right? You want longer term. Just longer is better for the bank. It's more time to collect payments on that loan, right? More activity, more book of business for the lending institution. So I'm going up to 84 months. Some of these mortgages, if you get a 30-year mortgage, it's going to go up for 360 months, right? Is that right? 36, 6 and 6 is 36. Yeah, I think that's right. All right. Let me do a quick calculation here. Now I'm second guessing myself. I think so. Okay. Calculator. 12 times 30. Yeah, 360, right? So some of these go up to 360. In this case, I'm cutting off at 84 months. That's fine. And was 84 divided by 12. Sorry. Sometimes my math is spot on. Sometimes I just get distracted by these things. Yeah, 7 years. Okay, so this is a 7-year loan, and this can be typically student loan. This could be probably an automobile loan, something like that. That would probably fall into that. Could be a mortgage. Usually you don't get 7-year mortgages, but you could get like a 7-year interest only. I've definitely seen those. Okay, so use your imagination here, but after 84 months, these loans, in this case, like this could be very different, right? I'm not saying this solves every problem in the world. This is solving this specific problem, okay? And this is my approach to solving the problem of loan approvals. And there's probably a couple different ways to solve this type of problem. Maybe there's half a dozen ways, maybe there's more. I'm not saying this is the only way to do it. This is definitely one way to solve this type of problem, okay? So, okay, so that thing is done. It took several minutes, so I had to pause the video. So at this point, we have the chart rendered down here. And again, we are filtering out like the obvious debt to income and payment to income caps. After that is taken away, because we know we don't want to do business with this crowd, right? The remaining offers tend to have pretty much similar monthly payments. They kind of fall into the same bucket. There's exceptions, but it's pretty much cookie cutter at this point. So here on the x-axis, we have the APR percent. On the left side of the y-axis, we have the expected profit. And you can see as profit increases, as the APR increases, right? That's pretty much common sense. And then the acceptance rate is on the right-hand side of the y-axis, right? So you can see the, what is this called? The chart legend, I think it's called a legend or something like that. And these are kind of nice. You can interact with these things, right? Turn on or turn off if you want to do so. And then you can zoom in, of course, and then zoom out to get that big picture there. So the expected profit for the 84-term loan, this is 7 months, right? 7 times 12 is 84. This is going to be the most profitable. Again, like if you're sending money to somebody for 36 months, that's just 3 years. Not super profitable. You really want to go for the 84 term, just more money for the bank, right? The longer you have the loan outstanding, the more interest payments that you are going to collect. That's just basic mathematics. There's nothing hard to understand there. And then we have an intermediate 60. So what is this, 5-year loan? I think that's a 5-year loan, right? So that's it. So there's the graph for that. Then we have the probability of default, loss given default, and the approval rate or the approval percentage on the loan. So I created another UDF for that. So we're going to plot this chart over here and just see like what's the APR percent. If people are defaulting, how much is that going to cost the bank, right? There is a risk there, and that's money going out the door that you're never going to get back, right? But that should be pretty minimal. We did the pretty thorough analysis here, so I'm pretty confident that most of the potential bad loans are gone. They're certainly gone over here with this crowd, DTI and PTI. If they don't meet those thresholds, like I said over here, right? We can go back here. This is automatically filtered out. The rest of it gets more complex, right? But that's why we're doing the analysis to see what do we want on the books and what do we not want. So if we look at the top loans over here, the probability of default is accuracy 0.77. So 77% of the time, we're going to be spot on. About 23% of the time, we could make a mistake. Okay, the model is not perfect, but it's giving you pretty good insight into this crowd. 77% of the time, the model is going to be accurate. Loss given default, mean average error is 0.039. So close to 4. But that's pretty low error, and that's what we want. Lower error is better. Higher AUC is better, so we want this to be closer to 1.77. There's ways to embellish the model or work with it or get that number up. This video is not about producing higher accuracies for models, right? It's a whole nother topic. We could come back to that and address that. There's hyperparameter tuning. We could try different models to get the accuracy up. Not too concerned about that. I'm just trying to prove the point here. So this looks good, and these are the most profitable loans right here. So the expected profit is 48,371. This is number 2 most lucrative loan. This is number 3, so this is the top 10 down here. And how am I doing this by? I wrote this code a few days ago. Now let me go back here. Yeah, that's fine. We're looking at the top 10. Right, so these are the loans that will be issued, definitely depending on, based on the terms of the loan and everything. And we know the expected profit at this point. So this is for the first group, B1, borrower 1 group. This is a bucket of borrowers. For borrower 2 group, these are the most expected highest profits for these loans: 3.9, 3.2, 3.7, down to $2,091. That would be the expected profit on those loans. So these 10 should be signed off on. That is a done deal. These 10 should be signed off. That's a done deal, right? So we're just looking for the most lucrative opportunities here for a bank. So yeah, I got a little bit distracted. So we have the 84 term. That is the best term for the bank, right? The more time that we have this customer on the books, the better. So here's the 5-year, right? And here's the 3-year, but you can see you're not making a ton of money from this 3-year guy down here. 5 is okay, that's intermediate. You really want to go for the longer term 84-month loan. And if you look here, all these terms are 84, right? So 84 is definitely the most lucrative. I could almost make an argument like if a person wanted a 3-year loan that like don't even get involved, but I don't think you should discriminate like that either. It's not going to be as lucrative for the bank, but I think if you start saying to people, hey, we don't want to do business with you because it's only 3 years, it's kind of discriminatory, and I don't even know if that's technically legal or illegal, but I mean, you should make the bank services available to a wide variety of customers, not just say, hey, 84 months, take it or leave it, right? Like clearly these are the most lucrative loans, but if you can help out a guy for 3 years and build up some goodwill, maybe he'll come back to you for an 84-month loan after the 3-year loan is paid off, maybe. So we're looking at the bottom, APR percent, probability of default, loss given default. And we can zoom in here. We can see that this light line right here is the loss given the default. The loss is pretty low in most cases. It's about 1.25%. These are the APRs. On the bottom, you can see the APRs really don't change that much for all these loans, right? There's a slight bump over here of probability of default, but it's pretty steady. It's pretty common. You're not going to see like a big change over time. So that's the risk. And again, the probability of defaults for 36-month, 60-month, and 84-month are pretty low. Like, what's this? 0.5%, 0.37.4. Again, it's not going to be zero. There's going to be some deadbeats out there, but the bank's just going to have to eat it, and you're going to make a ton of profit with the rest of the people. So I think it's fine. What else here? Minimum APR 6%. Long-term is 84 months. And we said that this can be different in your bank. I understand your scenarios can be different. Just giving you one option here to consider, right? So, sorry, this acid reflux has been bothering me for like a decade now. I can't get away from this thing. The loan term is 84 months. That's the longest one. In this scenario that we're issuing, in other banks, it could be different, right? Up to 30 years for 30-year fixed for a mortgage. Payments are 175. Payment to income is 0.042. So pretty low number. That's fine. Debt to income is 0.48. That's totally fine. Actually, no, we want debt to income to be less than 0.45 and PTI to be less than 0.35. So this guy is way under payment to income, but the debt to income is a little bit high. So he's probably going to get kicked out just for that reason. But that's okay. That's okay. We still have enough people on the books right here to run a very lucrative business. Let me hit Control Enter to refresh this chart, and we're almost done. Hang with me, guys. So at this point, we have a very high expected profit. We kicked out all the deadbeats. They are gone. We're not doing business with them. So at this point, the APR is the annual percentage rate, and this upper bound is about 36%. This is the longest term, 84 months. Okay, so bucket one, or bucket of business one, we're going to make about 36% return on these investments. ROI, you can call it profit, whatever you want. So it's 36%, pretty decent. And bucket two, it's not quite that high. These are just a different type of loan, right? We're only making about 9.8%, not even 8%, not even 10%, right? Close to 10. This is 36. But that's fine. It's just different types of borrowers, different profiles. Oh, this thing is gone. So I didn't know that was going to happen. Let me refresh this thing. So the memory on my computer is kind of low. I mean, it used to be a pretty fast computer, but these days it's just getting older and slower. So this is the B1, remember, borrower one, and the expected profit is pretty huge over here, right? So we're making 48K down to 44K down here. This B2 bucket, the borrower two bucket, is just like a different type of customer, right? Different risk profile. we're not lending as much money. The term is still 84 months, right? These longer term loans is definitely making more money for the bank. There's no question about it. You can see that in this chart, right? Anything that's 84 months over here is going to be in orange. And this is definitely the best place for the bank. But again, you have different types of customers, different risk profiles, right? So this is B1 profile, this is B2, just different customers, different types of borrowers, different needs. And that's it, right? So it is what it is. But overall, we did a pretty comprehensive analysis. We have good business here, very profitable, very lucrative. I think the risk manager and his team is going to be thrilled. I think the data scientist team is going to be thrilled. I think the business analyst people here are going to be pretty happy. Finance, operations, everybody is in a happy mood because we did a thorough analysis and we found good customers here that we want to engage with. And we have the list. All we have to do is print that out, start contacting the people and start issuing these loans, right? And start collecting some money for our enterprise. So that's it. The optimizer prefers long-term loans. 84 months is the ideal. It's not going to be desirable for everybody. Some people need a 5-year loan. Some people need a 3-year loan, right? But in this case, the ROE and the NPV targets are best at 7 years for 84 months, right? So there's a large gap between B1 and B2. It just comes from different loan amounts, different risk profiles, different acceptance elasticity, right? So these things can be more elastic or less elastic. You could charge just a little bit more APR and have a bunch of people say no. If you charge more and more APR and people tend not to say no, they still say, I want to do business with you. It's more elastic, right? It's more stretchy. Sometimes, depending on the economic environment and the terms and conditions of the loan, just 1 or 1/2 of 1%, you can lose a lot of business. Sometimes you can jack up the APR 2, 3, 4%, and people still want to do business with you, right? They don't care. It really depends on the economy and people's, I guess, confidence in their business and what they need the loan for, right? So the risk profiles are different. That's why you see different ROEs over here in NPVs, net present value, and return on equity, right? So that's it, guys. I'm going to wrap it up here. I will save a copy of this. I'll share all the code with you, save and export HTML. So you have that. You can copy and paste it into your own Jupyter notebook environment and run the code. If you have questions, let me know, post in the comment section. But some of these things, if it's just a general question, just Google it or use ChatGPT, play around with the code. I would encourage you to make changes, make modifications, make improvements, right? And see what the outcome is. And that's how you're going to learn this stuff, right? You can learn a lot just by playing around with the code. If you just copy and paste it and run it, you're probably not going to learn a ton. If you start changing some of the parameters in this chart over here, when I build this chart, when I'm building this chart, when I'm doing the modeling, right? And getting, here's all the model features and the model performance over here. Change that, see what the outcome is, and just have fun with it, guys. This is all about learning and having fun. That's pretty much it. So where are we now with time? 28 minutes. Okay, under 30. I like to keep these things under 30. Pretty tight, pretty efficient. I'm happy with this one. Okay, that's it, guys. I'm going to wrap it up right here, and I will see you in the next one. Goodbye for now.